Hello everyone and welcome to today's blog. In this blog, I want to talk about an article presented by PIMCO, Pacific Investment Management Company, and the article relates to late cycle investing. I found the article very interesting because PIMCO is not only discussing the current challenging world of investing, such as inflation, the run-up in prices for the stock market and other items, but also discusses opportunities in terms of how we can invest and take advantage of the current environment. All right, so let's go through the article and review it. PIMCO talks about four key themes. I'm not going to cover all of them, but I do want to talk about some of them. So one of them is inflation. And PIMCO talks about how investors should understand the inflation sensitivity or inflation beta of their portfolios. Now, PIMCO lists 5 assets here and their reaction to inflation. In Canada, we had a 3% inflation rate in July, and it's very, very similar in the States. So we need to understand how sensitive our assets are to this metric. So equities have an adverse beta when it comes to inflation. So the beta of minus 1.2, meaning when inflation goes up, equity prices go down. Same is true for regular bonds. Inflation increases, bond prices decrease. REITs seem to be independent. They don't seem to be correlated with inflation. If you want to take advantage of further inflation, if you believe that inflation will increase, as many people do, 2 opportunities here are TIPS, which are Treasury, inflation protected securities, and commodities such as gold, oil, and other commodities. If inflation goes up, these securities will increase in price. So when it comes to TIPS, Treasury Inflation Protected Securities, it's basically a bond or issued by province or a country, and the bond is indexed to inflation. So let's say I buy a bond today for 100, or I spend $1,000. If inflation is 3%, the bond will increase in price by 3% and will also pay a coupon to me. So it protects me against inflation. When I redeem my money, my purchasing power is protected. Commodities have a very positive inflation beta, so consider them when it comes to your portfolio. At least you can use them to diversify your portfolio. Don't just hold equities and bonds, but other asset classes. In terms of stock and bond correlations, PIMCO differentiates between 2 scenarios. Stocks and bonds can be either positively correlated or negatively correlated, and they describe it very well in this paragraph. So they're saying that when above average inflation starts being a bigger risk than below average inflation, bonds become a less reliable diversifier for equities and other risk assets. So if you're running in an above average inflation scenario, and it seems that we're going to be running through that experience for the next couple of years, bonds are not a very good diversifier when it comes to your portfolio. So inflation goes up, equities will go down, and bond prices will go down as well. And this is just a historical overview. There are many other factors. There may be political instability, money supply, other issues that the country may have, but this is just the research based on the historical data that PIMCO is presenting. So instead of using actual bonds, you can use TIPS. So it's the same sort of idea. Instead of investing in a bond, consider an inflation-linked bond. And there are some good ETFs on the Canadian market. There's one from BMO, which is ZRR. and another one for my shares, which is XRB. And I think the BMO ETF is a little bit cheaper, so consider that one for your portfolio. But just remember that during the inflationary periods, the portfolio theory changes a little bit, whereas you have to use advanced instruments to make sure that your assets remain stable. PIMCO talks about dispersion as well. I'm not really going to cover it. It's not really important to my portfolio. I invest usually in mutual funds and ETFs, and I don't really use this concept when it comes to my portfolio, but you're welcome to read the article and see if it applies to you. As well, PIMCO has talked about market volatility, that it has been increasing for a number of reasons. So how do we take advantage of this environment? So the first opportunity is the shorter maturity bonds, right? When it comes to an inflationary environment, you don't want to buy a long-term bond because likely that bond will depreciate in price, right? If the inflation goes from, let's say, 3% right now to 10%, the bond that is issued at 3% will lose much more value if it's a longer term bond than if it is a shorter term bond. It's a very basic concept in finance, but longer term securities react to inflation in a much more sensitive way. So consider the short term bonds for your portfolio instead of longer term bonds in an inflationary environment. Now, PIMCO also talks about the yield curve here. What is going to happen to the yield curve? So the US yield curve right now is flattening, meaning the the difference between short-term rates and long-term rates is declining. There's a spread chart that they have here, the difference between the short-term and long-term bond yields as of June 29th. So it is declining, and what's happening is people are buying the long-term bonds at this stage. They're buying it, they're bidding up the price, and PIMCO believes that the long-term bonds are overpriced for several reasons. Right now, there is a special tax rate that is applied for pension contributions in the United States for the long-term bonds, and there's some institutional interest in the long-term bond market, and institutions keep buying it. There are other reasons as well here for the purchases, but PIMCO believes that central banks will stop buying bonds. So they say, we feel that all these are likely to reverse as the large US deficit combined with Fed balance sheet unwinding will supply plenty of long-term bonds to the market. So US is running a deficit, meaning they have to borrow money in the market, and at the same time, not only US has to issue bonds to finance their deficit, but the Federal Reserve, is selling bonds as well, meaning that the yields are likely to go up. So you have to be very, very careful with your portfolio. The same is happening with other central banks, and PIMCO recommends that you don't go longer than a few years here when it comes to bonds. PIMCO is also talking about the emerging market currencies, that potentially you want to go into the emerging markets and invest into other markets. I don't know if I completely agree with that. I think United States is causing a lot of political turmoil when it comes to emerging markets with the trade tariffs. They did so with Russia by imposing tariffs and sanctions against Russia as well as Turkey, as well as other countries, including Canada. And I don't think that emerging markets are safe. I think there are other opportunities, but you can, there's an article here at the bottom of the PIMCO's report, and you can read it and see if you agree with them. I do not agree with them on that, and I'm not going to emerging market currencies anytime soon. Gold, PIMCO says that gold outperforms during the periods of rising inflation, And right now they are stating that it is underpriced. It seems unusual that gold lost 10% in the last 3 to 6 months, and they are considering, or they're asking us to consider gold for our portfolios. Gold is a real asset, and it's also a unit of exchange. You can actually price anything in gold and see what it is worth. We used to be in a gold standard, so you can sell gold, you can trade gold, you can store it under your pillow. And if inflation, let's say, is running at a high rate, like 1,000,000% in Venezuela right now, if you had gold instead of paper money, you would be king. But many people held paper currency or fiat money, and they are not really, they were not able to store value. So just to store value, consider some gold in your portfolio. Large cap versus small cap. PIMCO talks about how large cap equities may outperform late in the business cycle. They're presenting other arguments such as, they're saying while this view has some merits, we feel buying lower quality, lower value, high volatility small cap stocks is unlikely to lead to outperformance should a real trade war commence. So small cap is just riskier, and PIMCO believes that you should get out of small cap, and I agree with them on that. They also have an article here on emerging market currencies and how if you held emerging market, you would outperform when it comes to your portfolio compared to S&P 500 and US dollar. So once again, very simple themes for investing: short-term maturity bonds. We have basket of AM currencies, gold, large cap stocks, and as well as other assets such as REITs, treasury inflation protected bonds, and commodities. So just consider those for your portfolio. I encourage you to read this article in full. This is just a summary that I wanted to share with you and bring it to your attention. So this is it for today's vlog, and thanks very much for watching.